Good evening. Welcome to We Mean Business. I'm Anisha Nair Dhawan. In order to cut the strain on India's current account deficit because of huge gold imports, the finance minister proposed indexation of bonds and he proposed inflation index bonds, which we hear will be launched very soon. Will these bonds be able to drive away investors from gold, which is being bought as a hedge against inflation? To discuss this, we are joined by Moses Harding, Executive Vice President and Head of ALCO and Economic and Market Research at Indusind Bank. We have Mr. Roongta, CEO of apnapaisa.com. We've got Shashikant, Managing Director of Center for Investment, Education and Learning. We have Mr. Rajiv Bajaj, he's VC and MD at Bajaj Capital, joining us in Delhi. And we have Mr. Arvind Chari, Senior Fund Manager, Fixed Income with Quantum AMC, and Mr. Devendra Pant, Chief Economist and Head of Public Finance with India Ratings, joining us in Delhi. Welcome to We Mean Business. Before we begin our discussion, let's focus on the macroeconomic data released today, which is on wholesale inflation. The WPI, or the Wholesale Price Index, has come in lower than estimates at 5.96% compared to 6.84% seen in February, mainly because of softening in food prices. But inflation for January was revised sharply upwards to 7.31% from 6.62%. Ira Dugal explains the implications of the data released today.
The quicker than expected fall in inflation is continuing, telling you two things: that yes, price pressures in the economy are coming under control, but on the flip side, is it telling you a story of demand destruction as well? We'll get to that analysis, but let's get to the data first. What you got in terms of WPI today was a 40-month low reading, so we haven't seen these numbers for a long time, more than 3 years. 5.96% is the reading on March WPI. That's below the 6.3% being expected, and it is definitely a steep fall from the 6.84% that we saw in the month of February. A bit of spoiler coming in the form of the revision that you saw on the January numbers. So January WPI was revised to 7.31. That's quite a steep revision from 6.62%, which was the original number, but we don't know if this is a one-off or if this is a trend that is actually going to play out. So let's get to the March number and the breakup of the March number. Manufactured goods and core inflation, those are the two things to focus on. Manufactured goods inflation is down to 4.07% versus 4.5%, and core inflation has gone to 3.5%. Stay with this chart for a minute, because the pace of fall in both manufactured goods and core inflation is telling you that the demand conditions in the economy are extremely weak. In fact, some people are calling it demand destruction, and that's yet another negative indicator that's coming in on the growth side. So while it's positive that price pressures are under control, what they're telling you about the broader economy is anything but positive. Beyond those two data points, if you look at some of the other indicators, fuel and power inflation was down to 10.18% in March versus 10.47%. The other story that's playing out, apart from just the diesel price adjustments, is global fuel prices, which have been coming down, which definitely is a positive for us from an inflation and a current account perspective. Primary articles inflation came down to 7.6% versus 9.7%, and food article inflation came down to 8.7%. Part of this, though, was on account of a very significant base effect which played in. Let me just talk about the month-on-month changes quickly. The all commodities index was up 0.2%, manufactured products were up 0.1%, fuel and power 0.4% increase, primary articles 0.4% increase, but none of these are very steep. They're just very moderate increases, so one doesn't need to pay too much attention to it, except to say that the trend in inflation is lower in terms of the year-on-year number. On the month-on-month trajectories, it's largely flat. The implications, that's what you need to focus on, because you have an RBI policy, as always, coming up fairly soon. The fall in wholesale price inflation, particularly to below what the RBI had indicated for March 2013, is definitely going to ease the RBI's decision a little bit. In particular, like I said, the core inflation fall is telling you a story of demand destruction. You actually, juxtapose that with the GDP data, then it tells you that the RBI should be worried about growth and should act on growth rather than on inflation right now. Plus, food and CPI has also started to turn lower, so that's another window that the RBI gets. The only spoiler, as I said, is that 70 basis point revision in the January number. You have to take note of that, but you need to wait and see whether that's a trend. But as things stand right now, it looks like a 25 basis point cut from the RBI is fairly likely. They may couple that with some sort of a liquidity adjustment measure. May not be a CRR cut, but maybe a continued commitment to open market operations to ensure that the RBI's policy actions actually filter through the system.
In a gradual way, inflationary pressure is coming down. The fact that this is the first time it's below 6% is very important. And I hope that we'll continue to see that softening. Remember, if the January number has been revised upward, then the extent of slowing down of inflation is actually greater than the unrevised numbers show. But yes, there are monthly. That's why I don't think one month doesn't make a summer or whatever it is. You need to watch this. But all I can say is that inflation behavior is consistent with what the government has been saying, that it is slowly coming under control. You need to watch it certainly for another few weeks or so. But if it turns out that it is coming down, I think that will be very good news.
Mr. Roongta, I'd like to ask you, as we start the discussion, how attractive will inflation index bonds be when inflation itself is headed lower?
Well, I think if you're asking me about consumers, I mean, regular retail consumers, and there are a lot of bankers on the panel, and I'm sure they can answer it much better than I in terms of interest that banks and financial institutions would have. As far as consumers are concerned, I don't know, inflation index bond, how popular it will be. It's a complicated product, and I don't think retail investors like complications. It depends on how it actually comes out. We still don't know the exact manner in which it will come out. But I would suspect even if it becomes a little popular, it will take a little while to grow on retail investors, and I suspect that the major exposure will be through surrogate means. I mean, pension payments are going to become big soon, with NPS corpus also growing and other pension corpuses growing, and I think that's an ideal party to invest in inflation index bonds that will give rise to inflation indexed pensions, and I think that really is a need of the hour, and I think that slowly over time might excite some individual interest in inflation index bonds as well.
Ms. Pant, what do you think? Do you think because it's so complicated that they didn't really work the last time around they were introduced, or can this hurdle be bridged?
The first time it was introduced was in 1997, when it was only the principal amount which was indexed. The second trial in 2004, they indexed both principal and interest payment. Why there is a need for inflation index bond? Because what we have observed, if you look at the two fundamentals of the macroeconomy, which is getting a hit over the last few years, and one of them is either you look at it from the current account side or you look at it from saving investment gap. When inflation is high, and especially when the high inflation is originating from the food prices, what you get, a larger proportion of household budget is spent on food. So there is a hit, or the people are spending more money on the consumption, and you have the lesser amount of savings. Now, whatever savings is left, a larger proportion is moving towards saving in physical assets rather than on the financial assets. So what we are seeing investment going up on the gold, and investment going up on the property. Now what people are doing, people are hedging against inflation, high inflation, by investing in riskier assets like gold and property. Take a situation, somebody who have invested in gold at 33,000 per 10 gram, within span of a week or 10 days, it is 27,000. So it's directly a hit of roughly around 20% on its investments. Now, what government is trying to do is, by this, say for example, if the promise assure like 2% will be the real interest rate.